All right, let's talk about what I believe is the single biggest theme on the horizon for all of us in the markets, and that is the coming weakness in the US dollar. I see a shift coming that's going to fundamentally reshape the Forex landscape by late 2025. Now, this isn't just another dip you see on a chart. We are talking about a major structural rebalancing, the kind of event that can truly define a trader's career for years to come.
You know, for as long as most of us have been in this business, the US dollar has been the undisputed king of global finance. Its reign has felt so total, so absolute, that it's easy to forget a very simple rule of history. Even the mightiest dynasties, well, they eventually falter. And right now, all the signs I'm seeing are pointing to a fundamental challenge to the dollar's long-held dominance. Look, the dollar's power didn't just happen by accident. It was cemented way back in 1944 at Bretton Woods, which effectively made it the world's reserve currency. But here's the thing, its strength has never been absolute. We saw proof of that in 1985 with the Plaza Accord, which showed the world's major economies could and would engineer a decline of the dollar when it got too strong. And now, all the data suggests that 2025 is shaping up to be the next major inflection point in this huge multi-decade cycle. Okay, so here's our game plan for this breakdown. First, we're going to examine exactly why the dollar's dynasty is looking a little shaky right now. Then, we'll listen to some really important echoes from history, focusing specifically on that Plaza Accord. After that, I'll lay out the 3 core reasons I see for this coming shift. And finally, the part we're all here for, we'll set the new Forex stage and pinpoint the opportunities this is going to create.
For almost 80 years, really since the end of the Second World War, the US dollar has been the absolute center of the financial universe. But the ground underneath this dynasty is starting to tremble. We're moving away from that era of unquestioned dominance and heading towards a new multipolar reality.
Just stop and think about the sheer scale of this imbalance for a second. A single country, with less than 5% of the world's population, has held more financial power, more sway, than the other 95% of the world combined. Every single decision made in Washington, every tick up in interest rates, can literally create a boom or a bust thousands of miles away. This level of centralized power isn't just unprecedented. In today's globalized world, it's becoming completely unsustainable.
And that brings us right to the heart of this analysis. The market is flashing all kinds of signals that we are approaching a major turning point. This isn't just about regular economic cycles. No, this is a structural realignment of global finance, and I'm convinced late 2025 is going to be the moment this shift really kicks in high gear.
Now, if you think a coordinated takedown of the dollar sounds a bit like a conspiracy theory, I want you to look at the history, because it's not a theory, it has happened before. Let's talk about the Plaza Accord of 1985. It is the ultimate proof that a dollar decline can be and has been engineered.
So back in the early 80s, the dollar was so incredibly strong that it was crippling the export economies of key allies like Japan and Germany. It was creating this massive, unhealthy global trade imbalance. So the world's 5 biggest economies met, in secret, at the Plaza Hotel in New York, and they made a pact. The goal was explicit. It was right there in black and white. Work together to weaken the US dollar. This was not a market accident. It was a carefully planned intervention.
And the impact? Well, it was nothing short of seismic. I mean, just look at the result. In only 2 years after that meeting, the US dollar lost over half of its value against the Japanese yen. The Forex market was an absolute firestorm. Traders who understood the trend, who saw what was happening and bet on a weaker dollar, they made fortunes. And those who fought it, they were wiped out.
So the crucial takeaway here is this. These major moves in the dollar, they are not random noise. They are the consequence of deep, fundamental shifts in the global economic and financial structure. The story of the Plaza Accord teaches us that what we're seeing today, this buildup of pressure for another rebalancing, it's all part of a historical pattern.
So, the big question is, why now? Why is 2025 the focal point for this massive shift? Well, it's not just one thing. It's more like a perfect storm, created by 3 powerful, interconnected forces that are all challenging the dollar's long-held hegemony.
These 3 drivers are, first, the inevitable reversal of the Federal Reserve's monetary policy, second, the undeniable rise of credible rivals to the dollar, and third, something more subtle but just as powerful, the erosion of market confidence in the U.S. financial system itself. Let's dig into each one of these.
The dollar's recent strength has been overwhelmingly tied to the Fed. Just think back to 2022 and 2023. The Fed was hiking rates at a historic pace to fight inflation. That's a hawkish policy.
designed to tighten money, and it made the dollar the ultimate safe haven. But that hawkish, high-interest rate era, it's ending. As inflation cools down, the Fed is expected to pivot to a more dovish stance. That means they'll start cutting rates, likely back to a neutral zone of around 2 to 3%. The moment that happens, the dollar loses its high-yield advantage, and big global capital will start looking elsewhere for better returns.
We're also living in a world where, frankly, the dollar is no longer the only game in town. You've got central banks around the globe buying gold at a record pace. You have nations like China and entire blocs like the EU pushing forward with their own central bank digital currencies. And critically, you have the BRICS nations, that's Brazil, Russia, India, China, and South Africa, actively working to trade amongst themselves in their own local currencies, bypassing the dollar completely. And of course, you have the whole world of decentralized assets, like crypto, gaining traction. Each one is maybe a small cut, but you add them all up, and they represent a huge challenge.
And finally, there's the one thing you can't really put on a chart: confidence. Currencies at their core run on belief, and belief in the unwavering stability of the U.S. financial system, well, it's being tested. We have record-breaking national debt, deep political polarization, and the very recent, very painful memory of regional bank failures. All of these things are chipping away at that foundation of trust, and no currency can hold its top spot if the bedrock of confidence begins to crack. Okay, so we've laid out the history, we've identified the core reasons for this shift. Now we get to the most important part. What does this actually mean for us as traders? How do we translate these massive macroeconomic trends into real, tangible trading opportunities on this new Forex stage?
So here's a forecast based on the capital flows I expect this shift to trigger. A weaker dollar, simply put, makes other assets more attractive. I anticipate a bullish trend for Euro USD, potentially pushing up towards that 1.20 level as the European Central Bank keeps its rates relatively higher. For USD JPY, I see a strong bearish trend, down towards the 115, 120 zone as the Bank of Japan finally moves away from its ultra-low interest rate policy. And for assets that are priced in dollars, like gold and Bitcoin, a weakening dollar acts as a powerful tailwind. I see that pushing gold towards $2,800 and giving Bitcoin the fuel it needs to challenge its all-time highs.
So where does all that money from the dollar go? It doesn't just disappear into thin air. It reallocates. And this is what I believe that reallocation is going to look like. We'll see it flow into Eurozone, which offers stability and a much better relative yield. It's going to flow to Japan as its decades-long era of extreme monetary policy finally comes to an end. It will rush into gold as the ultimate safe haven hedge. And for those with a higher risk appetite, it's going to find its way into crypto and select emerging markets in a global search for better returns.
Now, it's absolutely critical to understand this. A weakening dollar is not a catastrophe. It's a rebalancing. It's healthy. When one currency dominates for so long, the global market naturally seeks to correct itself. This is not the end of the financial world, it is the beginning of a brand new cycle. And for us as traders, that new cycle means one thing above all else: volatility. And volatility means opportunity.
So how do you prepare for this? First, you have to focus on the long-term trend. This isn't a one-week trade, it's a multi-year cycle unfolding. Second, understand the connections, the correlations. A weak dollar lifts gold, it lifts crypto, it lifts foreign stocks. These markets do not move in isolation. Third, and this is non-negotiable, prioritize disciplined risk management. Big waves can bring big profits, but they can also sink your ship if you're not careful. And finally, prepare your mindset. The market is going to get wild, but for the prepared trader, that's exactly where the best opportunities are found.
Let me leave you with a really powerful idea. In a market shift of this magnitude, wealth isn't actually destroyed, it's simply transferred. It moves from the pocket of those who are unaware or unprepared to the pocket of those who understand the game and see the trend forming ahead of time. The weakening dollar is that transfer mechanism in action.
The era of absolute dollar dominance is ending, and a new, more dynamic Forex market is being born right before our eyes. The global flow of capital is fundamentally shifting. So the only question that really matters now is, are you positioned to catch that wave, or are you going to be left behind on the shore?